Cameron Brandt is Director of Research at EPFR Global Tracks Flows. Cameron, great to have you with us here. You heard Mobius there. Is it showing through in flows, Cameron? India being the top emerging market bet. I was also, just to sort of preface my question, I was also listening to Ruchir Sharma, who's, of course, with the Rockefeller Institution. He said he was making a point that some of these sort of emerging market ex-China strategies, to him, he said it seems like a fad. It's not possible that, it's just sort of coming and going. 5 years back, everybody wanted to go in China. Now no one wants it, so it'll pass. So it's not a sustainable kind of a strategy. It's a fad. Just wanted your thoughts there. India and then China. Go on.
I'll start with the flows. The flows to dedicated China funds are correcting again, being very flat despite the government's efforts to support the market. India remains, as I've said on a number of these calls, sort of the tall poppy in the emerging Asian field. And after a slight lull over the past couple of weeks where flows haven't gone into reverse but have been somewhat lower, they picked up nicely last week and they look like this will be another solid week. You're certainly right that we're seeing a lot more talk about how you invest with an ex-China focus. And I can understand anyone being skeptical. I've lived through BRICS, Frontier, Mint, Civets, MIST, you name the acronym, I've seen it pop up and fade. That said, I do think the exposure to China in the GEM funds that we tracked had gotten over a third of the average portfolio just after the global pandemic broke. So I think in some ways what's going on is a fairly natural reversion to the mean, given an extra boost by the much more frosty relations between the US and China, and the sense that the halcyon days of Chinese growth may well be over.
Since you're talking about frosty relationships between US and China, right? What is your take on what's happening with the way gold is moving? Of course, we have seen large buying from the Chinese central bank. But the question is this: if countries globally are trying to reduce their reliance on the dollar as part of their foreign reserves, could this be the start of a tectonic shift in the global power center away from the West and into the East? And if yes, what is the change in the dynamics in, in risky assets like, say, equities?
Well, I certainly think this is yet another effort to try and get out from underneath the dollar's hegemony. Previous efforts to do so have not been successful. And given the fact there's a finite amount of gold, it's not particularly easy to move around. I'm not sure that this one is going to work either. And though we're seeing very strong demand for gold at the moment and the price is going up, certainly at the fund level, really until early this year, what we saw was an investor cohort who thought that cryptocurrencies might be a better alternative to owning gold. So until the trend establishes itself much more firmly, I'm cautious about reading too much into it.
What about commodity-linked markets? Markets which are beneficiaries of this big rise that we've seen in commodities, whether it's copper at a 15-month high, gold is at a lifetime high. Any commodity-related plays that investors are watching given the upcycle that we've seen across the board? And is money flowing into any of these nations?
Yes, but it's not so much an emerging market story at the moment. There's been definitely higher interest in the two big what I call the big developed markets resource plays, Australia and Canada. We've not been seeing a corresponding increase in interest in, say, places like Brazil, Argentina, South Africa. So it's a real trend, but people are playing it carefully. They're going to all the safe places.
No, got that, Cameron. Cameron, just a quick word. You know, so interest rates, there's a big debate going on whether somebody was earlier mentioning they're playing good cop, bad cop. Data is going one way, officials are saying something else. The point is, does it all really matter? And in what degree, when we focus on interest rates in the West, right? What is the implication? Because it's not hard equity rallies, which have been very strong over the last couple of years. Rates in the US have got to 5.25%. So what if they come down in June or July or September? Does it really matter? They shouldn't go higher. Do you think that's the way to kind of look at this entire interest rate regime and where we go from here?
I agree that sort of this druid-like worship of the current Fed funds rate may be a bit overdone. You know, when you look at interest rates as a whole, I still don't think enough attention is being paid to the longer end of the curve. Huge debt issuance from the US and Europe, both the ECB and the Fed and the Bank of England trying to run COVID era and great financial era quantitative easing assets off their books. So I think it'll be a nice shot in the arm, but the real action over any meaningful period of time is further out. And from where I sit, I think interest rates, certainly the 10-year interest rates, will be settled at a higher level than we've been used to.
All right, Cameron, we'll leave it at that. Thanks a lot for joining in, and appreciate your thoughts on the Indian economies, emerging markets, and how things could shape up from here.